Hello friends, welcome to yet another video in our series Finance and Investing Tidbits. The theme of this video is time in the market and or timing the market. Welcome to the video. Mutual funds tell us that no one can time the market. In fact, that's the reason why they recommend SIP as a method of investing. And of course, I have a very critical video on this theme, SIP myths and reality, and I would share the link to that video in the description box of this video also in case you are interested. To some extent, they are right that no one knows exactly the bottom or top of a market. However, we all know that the nature of markets is such that they oscillate due to optimism and pessimism. Hence, knowing how markets behave is a very important aspect of investing. And once we realize that markets are always going to oscillate on the back of greed and fear, we obviously can be more careful when it comes to our investing. Thus, the mutual funds keep on telling us, even their advisors keep on telling us that time in the market is more important than timing the market. The two actually complement each other and there is no conflict whatsoever. So time in the market is important, no doubt about it, but timing the market should also not be ignored. It is clearly in the interest of the asset management companies which manage those mutual funds to say that we must remain invested and time in the market. In other words, remaining invested in the long term is very critical according to them. But there is a certain vested interest because their own income is dependent on we remaining invested in those mutual funds. And in principle, I have nothing against remaining invested for the long time, but it does not mean that it has to be a static investment. I'm going to create a separate video explaining how simply using two mutual fund schemes we can generate superior returns. So it is not necessary that we have to remain invested in each of those schemes. We can switch money from one to the other. So of course, I will talk about that in a separate video, but we have to be aware about their vested interests of we remaining invested, and as a result, they actually prod us to go in that SIP route. So not only we remain invested, but we keep on accumulating money into that particular investment, irrespective of whether it's a good time to invest in the market. In other words, the timing aspect of the market. The first principle of investing is that any prudent investor must apply one's mind. Thinking is the very first principle of investing. Now, what SIP makes you do is SIP makes you invest, irrespective of whether it's a great time to invest or not, right? So timing is something which is completely disregarded. The other problem with the SIP route is that it's a one-way traffic. You keep on investing and you never divest. We must realize that markets are cyclical. They go up and down in a very rhythmic way. That's the very important aspect of financial awareness that we should never forget about. It is never going to be a straight line. It is going to be ups and downs. So obviously we need to enjoy those ups and downs and even take advantage of them. Understanding this up and down movement, therefore, is the first requisite of investing, and we must invest some time to understand the cyclicality. It actually hardly takes any time to understand the cyclical nature of the markets. You can use any portal, any website which provides you data over 25 years, 5 years, 10 years, whatever horizon you want to look at, and you will find the markets are oscillating. So once we understand that, we must devise ways of taking advantage of it. So timing is really about understanding this rhythm of up and down and taking advantage of this rhythm by both selling and buying. Disregarding this rhythm, disregarding the right time of investing is actually the biggest risk. And instead of making us aware about that, we are actually prodded to go one way by keeping on purchasing units in a mutual fund, irrespective of whether the market is on the higher side or on the lower side, whether there is a high tide or low tide. We just keep on investing, and that's actually a mistake in my view. So while one would accept the argument of mutual funds that no one knows exactly the bottom, but there are enough indications of when markets are fearful and weak. For example, we are going through that phase right now after the Russia-Ukraine war and the supply chain disruptions, the enormous increase in food grain prices, and there was an increase in prices of oil and even other metals. They have now started to cool down gradually, but at that time obviously the markets become very fearful and weak. So do see my video on the tool that I have developed to assess the current level of the market, and again I'll provide a link to that video too, so you can yourself download an Excel tool just to check what is the current level of the market. Is it an attractive level to buy, or is it an attractive level to sell? So making that assessment is very critical. It is the best time to invest when markets are skeptical, fearful, and weak. Like the current scenario, it's actually the best time to invest. It does not mean that the markets may not correct a little more, and nobody can predict that. But overall level, in the context of the strength of the Indian economy, is very, very attractive. So you have to be kind of careful that fund managers practice one thing for themselves and preach something else to others. So they preach SIP to us, but they have the freedom to invest the way they want, and obviously they would time the market. They're not going to follow the SIP route. I can assure you that. So timing the market is important, but timing is also very, very critical. What I mean by timing is we have to know the current situation of the market. When the markets are weak, it's a great time to buy. When the markets are exuberant, we must also learn to book profits. So investing involves both purchase and sales. We must do both at the right time. We cannot get exact bottom and exact top, and we can follow a strategy of deferred purchases and deferred sales rather than trying to do it in one go, so that we are able to do purchases closer to the bottom in that range and closer to the top in that range as well. I hope you like this video, and if you have, feel free to share it with your friends. Thank you.